Welcome to our corporate finance series. Today, we're exploring working capital, a crucial concept for understanding a company's short-term financial health. Working capital reveals how well a business can meet its immediate obligations and sustain daily operations. By the end of this video, you'll understand what working capital is, how to calculate it, and why it matters for any business. Working capital is a measure of a company's short-term financial health and operational efficiency. It tells us whether a business has enough liquid assets to cover its immediate debts and expenses. The formula is straightforward. Working capital equals current assets minus current liabilities. This simple calculation provides powerful insights into a company's ability to function smoothly on a day-to-day basis. Current assets are resources that a company expects to convert into cash or use up within 1 year. These include cash and cash equivalents, which are the most liquid assets. Accounts receivable represents money owed to the company by customers. Inventory includes goods available for sale, and marketable securities are short-term investments that can be quickly sold. Together, these assets form the foundation of a company's short-term liquidity. Current liabilities are obligations that a company must pay within 1 year. Accounts payable represents money the company owes to suppliers. Short-term debt includes loans or credit lines due within 12 months. Accrued expenses are costs that have been incurred but not yet paid, such as wages or utilities. The current portion of long-term debt refers to the amount of long-term loans that must be paid this year. These obligations need to be covered by current assets to maintain financial stability. Let's walk through a practical example. Imagine a company has current assets totaling $500,000. Their current liabilities amount to $300,000. To find working capital, we subtract current liabilities from current assets. $500,000 minus $300,000 equals $200,000. This positive result of $200,000 represents the company's working capital, indicating they have excess liquid resources after covering all short-term obligations. Positive working capital occurs when a company has more current assets than current liabilities. This is generally a healthy sign, indicating financial stability and the ability to meet short-term obligations comfortably. Companies with positive working capital can pay their bills on time, invest in growth opportunities, and handle unexpected expenses. It demonstrates that the business is operating efficiently and has a cushion to manage its day-to-day financial needs without stress. Negative working capital happens when a company has more current liabilities than current assets. This situation may signal liquidity problems and difficulty meeting short-term obligations. While some highly efficient companies with fast inventory turnover can operate successfully with negative working capital, for most businesses it's a warning sign. It suggests the company might struggle to pay suppliers, employees, or creditors on time, potentially leading to serious operational and financial challenges. Working capital matters for several critical reasons. First, it ensures operational efficiency by providing resources for smooth day-to-day business operations. Second, it's a key indicator of financial health, revealing the company's liquidity position. Third, positive working capital provides growth potential by offering resources to pursue expansion opportunities. Finally, it serves as risk management, acting as a buffer against unexpected expenses or economic downturns. Understanding and managing working capital effectively is essential for long-term business success.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.